Good afternoon, ladies and gentlemen, and welcome to this webinar on essential trading basics brought to you by Errante. I'm Ali Mortaza, your guide through the complexities and opportunities of the forex market today, and let's embark on this exciting journey together. At Errante, we are committed to providing top-tier services to help you navigate the financial markets. We believe in building lasting relationships based on trust with our clients and partners. After all, a trustworthy partnership is key to succeeding in the ever-changing landscape of forex trading for Errante. So before we proceed further, it's crucial to note that the content presented today is purely educational. So this is not financial advice, so always conduct your own research and consult professionals before making investment decisions, because risk is an inherent part of trading, especially in complex instruments like CFDs. And I can't stress enough the importance of understanding the risk involved. A significant percentage of retail investors lose money while trading CFDs, so you must understand how they work and assess whether you can afford to take the high risks involved. Before we dive into the nitty-gritty, let's set the stage and outline what we aim to achieve today. Okay, our webinar is segmented into 5 core areas designed to give you a 360-degree view of forex trading today. We'll kick things off by introducing you to the forex market, where you will learn the basics, understand currency pairs, and familiarize yourself with trading positions in leverage markets. Next, we will delve, let me just run my laser point here. Okay, and next we will delve into the mechanics of trading. This is where you will get to grips with lot sizes, leverage, and margins, as well as how to calculate p-values, which is crucial for any trader. And the third segment will tackle risk management concepts. We will talk about equity balance and critical concepts like margin calls and stop out levels. And this part is all about ensuring you know how to protect your capital. Then following that, we'll explore the costs associated with forex trading, focusing on swaps. You will learn what they are, why they exist, and how they can either cost you money or become a source of income based on your trading approach. Finally, we'll open the floor to your questions. This is your opportunity to fill any knowledge gaps and clarify any doubts. So fasten your seatbelts, as we are about to take off on an educational ride through the fascinating world of forex trading. As we delve into the financial markets, remember they are as dynamic as society itself. Political shifts, technological innovations, and cultural changes all impact market movements. The world is more interconnected than ever, and events in one part of the globe can ripple across markets everywhere. So in this world, adaptability and continuous learning are your best allies. Having navigated the basics of the forex markets as in our previous webinar, let's pivot to a closely related and equally intriguing concept, the contract difference, or CFDs, as they are commonly known. CFDs are complex financial instruments that allow you to speculate on the rising or falling prices of fast-moving global financial markets. They are essentially contracts between a trader and a brokerage, and the difference between the opening and closing trade prices forms the basis of profits and loss for traders. One compelling aspect of CFD trading is that you don't own the underlying asset, be it a commodity index or a stock. This allows for flexibility, as you can trade on both rising and falling markets, and leverage is another feature enabling you to magnify your exposure to financial market without tying up the full cost of the asset. And speaking of exposure, let's look at the types of positions you can take, as we call them buy and sell, long buying, and short selling. Okay, when you buy, you're essentially going long, expecting the asset's price to rise. Conversely, when you sell, you're going short, predicting a decline in the asset's price. These positions are crucial because they determine the strategy you are deploying. For example, in a bullish market, you generally opt for a buy position, while in a bearish market, a sell position would be more appropriate. So CFDs offer a flexible, leveraged way to trade on a wide range of financial markets, allowing you to capitalize on price movements in either direction. Now that we have a firm grasp on what CFDs are and how their pricing works, let's move on to the actual mechanics of trading them. It's crucial to understand the dynamics of buying and selling CFDs in the forex market. When we talk about buying and selling CFDs in forex, we're essentially talking about going long or short on a currency pair. Let's break this down. When you buy a forex CFD, you're essentially opening a long position at a certain ask price, betting that the value of the base currency will rise against the quote currency. For example, if you buy a CFD on the Euro USD pair, you're speculating that the euro will strengthen against the dollar. Your profit grows as the price moves up, and you will close this long position by selling the CFD at a new higher bid price. Conversely, when you sell a forex CFD, you're opening a short position expecting that the value of the first currency will decline against the other currency, and using, for example, using the Euro USD pair as an example again, selling a CFD means you expect the euro to weaken against the dollar. So your profit grows as the price falls, and you will close this short position by buying the CFD at the new lower ask price. What is the ask price? I will explain it to you, so please wait. It's essential to remember that in both scenarios, buying or selling, you don't own the underlying asset. This is the point of this slide here. You are trading a contract based on the price movements of the asset, not the asset itself. So this gives you the flexibility to profit from both rising and falling markets, making forex CFDs an incredibly versatile trading instruments. In summary, buying and selling CFDs in Forex allows you to speculate on currency pairs movements without owning the underlying currencies, giving you the flexibility to go long or short based on your market analysis. So understanding the dynamics of buying and selling CFDs is one part of the occasion. The other equally critical part is knowing the assets you are trading currency pairs. Let's break down what makes up a currency pair and why it's essential. As you see here, I would say in forex trading, currencies are always traded in pairs, such as Euro USD, GBP USD, or USD JPY. Each pair consists of a base currency and a quote currency. The base currency is the first one in the pair, and the quote currency is the second. When you see a currency pair like your USD quoted at 1.1150, it means that 1 euro, the base currency, can be exchanged for 1.1150 US dollars, which is the quote currency here. In other words, the price you see is essentially the value of the base currency in terms of the quote currency. And now, why is this important? Knowing the base and quote currency helps you understand the direction of your trade. If you're going long or buying the pair, you're speculating that the base currency will strengthen against the quote currency. Conversely, if you are going short or selling the pair, you're betting that the base currency will weaken against the quote currency. In summary, the structure of currency pairs provides the framework for all forex trades. Understanding this structure allows you to make sense of price movements and informs your trading strategy, whether you're going long or short, buying or selling. Armed with the knowledge of currency pairs, let's shift our focus to another fundamental building block in forex trading, the very important concept of PIP. Understanding PIPs is pivotal for measuring price movements and managing your trades. A PIP, or a point in percentage, is a standardized unit of measurement for the change in value between two currencies. In most currency pairs, a PIP is typically the smallest price move uh, that can be observed in the exchange rate for that currency pair. For example, in the Euro USD pair, a 1 pip movement would be a change from 1.1150 to 1.1151. However, it's important to know that pips can be versatile. For major currency pairs like Euro USD, GBP USD, and AUD USD, a pip is usually the fourth decimal place in exchange rate, which equals to 0.0001. But for currency pairs involving the Japanese yen like USD JPY, a pip is the second decimal placement, which is the 1 pip in those yen currency pairs is 0.01. Let's not forget other asset classes. In commodities, indices, and shares, the concept of a PIP may differ. For example, in gold trading, in gold trading, a PIP could be a $0.01 change in price or a 1 cent, while for indices like the S&P 500, a PIP could be a 1 point change. And also, it may differ among the different brokerage companies. Why? But the point is that why is understanding PIPs so crucial? Because they are the basic unit for calculating profit and loss. They also help you set your stop loss and take profit levels, serving as a key tool for risk management. In summary, the concept of a PIP is versatile and applies across various asset classes, not just Forex, and mastering how to calculate and use PIPs is essential for effective trading strategy and risk management. Now it's time to get into the basics, the exact prices at which you can enter and exit in market. So let's unravel the concepts of bid, ask, and spread. In the world of trading, bid and ask are terms you will encounter every time you place a trade. The bid is the price at which you can sell an asset, essentially the maximum price someone is willing to pay for it. On the flip side, the ask price is the price at which you can buy, essentially the minimum price at which someone is willing to sell the asset to you. Now, let's connect these to your trading actions. If you're looking to go long or buy, you will open your position at the ask price and close it at the bid price. Conversely, if you are planning to go short or sell, you will open at the bid price and close your position at the ask price. The difference between the ask and bid is what we call the spread, calculated simply as ask minus bid, as you see here on my screen. So let's look some examples. For Euro USD, the bid might be 1.1150 and the ask 1.1152, making the spread 0.0002 or 2 pips. And for example, here for the USD JPY, a bid of 110.40 and an ask of 110.42 also results in a 2 pip spread. And in the case of the other types of asset classes like gold, a bid of $1,850 and an ask of $1,851 results in a spread of just the 1 cent. It's crucial to note that the spread can widen in volatile markets, affecting your trading costs. So some platforms might offer tighter spreads by offset these with commissions. And remember, spread costs can significantly impact short-term trading strategies. So always account for them in your risk management plans. Okay, let's now tackle a question that often puzzles forex newcomers. Why are there always two prices, the bid and the ask? In the forex market, you will always encounter two prices for every currency pair, the bid and the ask. At its core, this dual pricing system reflects the supply and demand dynamics of the forex marketplace. Let me repeat it again, as it's an important building block in trading. The bid is the price at which you can sell a currency pair, or more specifically, the highest price that a buyer is willing to pay. And on the other side of the coin, the ask is the price at which you can buy, representing the lowest price a seller is willing to accept. Now, you might wonder why not just have one price. Okay, well, the two-price system allows for a market to function continuously, facilitating instant transactions. When you want to buy, there is always a seller at the ask price. And when you want to sell, there is always a buyer at the bid price. So this continuous cycle ensures liquidity, one of the hallmarks of the forex market. Additionally, as you know, the difference between these two prices is called a spread, which is essentially the cost of trading. It's how brokers make money and how you need to account for trading costs in your strategy. So the existence of two prices in forex, bid and ask, ensures market liquidity, standardization, and functionality. Also, liquidity providers and market makers play crucial roles here, and the fluctuation between the bid and ask aids in accurate price discovery. So understanding this dual pricing system is key to grasping the mechanics of forex trading and incorporating trading costs into your strategy. The next, uh, let's move on to another essential concept, which is size of trade in forex. In forex and CFD trading, the term lot is used to specify a standardized quantity of units, which essentially defines the size of your trade. Now, let's break down the types of lots. We have the standard lot. This is the let's say the granddaddy of lots, equivalent to 100,000 units of the base currency in forex. And then mini lot comes. Mini lot represents 10,000 units, great for those who are new to trading or looking to minimize risk. And then the micro lot, as it is the 1,000 units only. A micro lot is even smaller and offers even more precise risk management. And then the nano lot, which is not offered by many brokers, but it's better to know it. And then we have the nano lot, which is just 100 units. This is micro as it gets. Now, when it comes to commodities and metals, CFDs, one lot of gold might represent 100 ounces, and one lot of oil might represent 1,000 barrels. For shares and indices also, often one lot equals one share, when you are trading stocks. And for indices, one lot could represent one contract, one contract that the size of which can vary depending on the specific index you're trading. However, understanding lot sizes is not just academic, it's practical because it directly impacts your risk management strategy and the value of each pip in your trade. Okay, guys, I appreciate if you give me some feedback so far. If you have any question during this webinar session, please write it down in the chat box. I will answer it as soon as I can get to them. Thank you. So let's continue with the math behind the moves. As we continue to unravel the mechanics of forex trading, so let's focus on another critical element that can make or break your trading strategy, the pip value. Pip value is the value of the one pip move in a particular currency pair. It's essential for setting your risk parameters and stop loss levels. Now, calculating p-value can vary depending on whether the USD is the code currency or the base currency in the pair you're trading. The formula for calculating p-value when USD is the code currency is straightforward. It's simply 1 pip divided by the exchange rate, all multiplied by the lot size. Let's consider an example as you see here. Based on this formula that you see here. Okay, it's simply, let's go to an example. If you're trading one lot of Euro USD at an exchange rate of 1.05000, the pip value in terms of USD would be $10. But what if USD isn't the code currency? Then you would multiply the usual p-value by the current exchange rate to get the p-value in the base currency. For instance, in Euro JPY, the pip value in terms of JPY would be pip value would be the 0.01 times lot size, and then converted to euro using the Euro JPY exchange rate. Now, why is this so important? Guys, understanding pip value is crucial for risk management. It helps you decide the lot size that is appropriate for your risk tolerance, and it also informs your decisions on where to set your stop loss and take profit levels. So whether you are trading a currency pair with USD as the code currency or not, understanding how to calculate pip value is indispensable for effective trading. So having grasped the concept of lot sizes, it's natural to wonder how the size of your trade affects its value in pip terms. So let's do some math. Let's focus on Euro USD to calculate pip value in USD. The formula is simply lot size multiplied by pip in decimal places. For a standard lot of 100,000 units, the pip value would be $10, as we mentioned earlier. And now, to get the pip value in terms of euro, you would divide that $10 by the current exchange rate of 1.05, resulting in approximately 9.52 euros. Or you have mastered the value calculation for Euro USD, but what about other currency pairs like Euro JPY, as we mentioned earlier? You can see all the formula here. Calculating p-value for Euro JPY is similar, but note that the pip is represented differently. For Euro JPY, standard lots will have a p-value of 1,000 yen. So to get the value in euro, you divide by the exchange rate, resulting in approximately 6.33 euro. And now, we've nailed down p-values for different pairs. Let's apply the knowledge to a real-world example. Imagine opening a sell position on 0.7 loss of Euro USD at a bid price of 1.05678 and closing it at an ask price of 1.05432. Your profit in USD would be $172.2, and in euro, it would be about 163.36 euro. Knowing your PIP values and how to calculate them is crucial for this sort of practical application. Having covered the essential of trading mechanics, it's time to delve into one of the most talked about yet misunderstood aspects of forex trading, which is leverage. Leverage is a financial tool that allows you to control a large position in the financial market with a relatively small amount of capital. It's expressed as a ratio, such as 1 to 50, 1 to 100, or even 1 to 200. The idea is seductive for sure. It's a small investment. You can amplify your exposure and potential returns. Let's consider an example to clarify the power of leverage. Suppose you have $1,000 in your trading account and you use a 1 to 200 leverage. Mathematically, this means you can control a position size of up to $200,000. This amplification can lead to larger profits if the market moves in your favor. However, leverage is not without its pitfalls. The same mechanism that amplifies your gains can also magnify your losses. Using our example, a slight adverse movement could result in substantial losses relative to your initial 1,000 investment. And this brings us to the concept of margin. Margin is the amount of capital required to open a leverage position. It's essentially a good faith deposit that you need to maintain to keep your position open. The higher the leverage, the lower the margin required, but the higher the risk. Here, you can see the corresponding formula to calculate the required margin. This is just for you to grasp behind the scene as trading platforms these days do all the calculations for you. However, in summary, leverage is a powerful tool that can boost your trading capital and potential returns, but it comes with increased risk and the necessity for effective risk management. Knowing how to use leverage wisely is crucial for long-term trading success. We have talked about the dramatic impact of leverage. Now, how do you calculate the actual margin required for a trade? Calculating the required margin isn't as daunting as it might seem. The formula involves your lot size and the current price and the leverage ratio. That's it. For instance, with a 200 leverage and a 1.5 lot Euro USD trade at 1.05, the required margin would be $787.5 in USD and 750 euros in terms of the base currency. Remember, the margin acts as a sort of a collateral, ensuring you can honor the trade. Now that you dissected margin requirements, let's shift our focus to the core components of your trading account, equity and balance. What is balance? Balance is the total amount of money in your accounts, excluding open positions. On the other hand, equity is dynamic. It includes your balance plus the profit and loss of your open positions as well. For instance, with a balance of 1,000, a running profit of $75, and a running loss of $40, your equity would be $1,035. If you close all open positions, your equity becomes your new balance. Equity and balance are essential, but what about the funds you have available for new trades? That's where free margin and margin level come into play. Free margin is essentially the money not engaged in any trade. Calculated as equity minus used margin, it's your financial cushion for new trading opportunities. And margin level, on the other hand, is a risk indicator that compares your equity to the used margin. Is calculated as equity divided by used margin times 100 and serves as a vital health check of your accounts. So bear in mind that the free margin is crucial for risk management and new trade opportunities, while the equity fluctuates in real time, while balance is a statistic. Sorry, balance is static until updated by a closed trade. As we venture deeper into the world of forex trading, it's essential to be prepared for all scenarios, including those less favorable. And that brings us to two other critical safety mechanisms in forex trading: margin call and stop out. Margin call and stop out are essential risk management features designed to protect both you, the trader, and the broker as well. Let's break down these terms to understand their importance and how they function. Firstly, margin call is a warning mechanism. When your account's equity falls below the required margin level, you will receive a margin call. This is the market's way of saying, hey, you're running low on funds to maintain your open positions. And at this point, you have few options. You can close some of your open positions to free up margin, or you can deposit additional funds into your account to meet the margin requirements. Now, if your account equity continues to fall and reaches an even lower threshold, that's where stop out comes into play. A stop out is the automate, automatic closure of your positions, starting with the least profitable ones to prevent further losses. This is the market's final safety net, and it's activated when your account's equity falls below a specific percentage of the required margin. And it's important to note that both these mechanisms are double-edged sword. While they protect you from incurring debts beyond your initial investment, they can also result in losses if your trades don't go as planned. Therefore, understanding margin call and stop out levels and incorporating them into your risk management strategy is crucial for long-term success. In summary, margin call and stop out are risk management tools designed to keep you in the game, but can also end your trading day abruptly if not managed wisely. Thus, always keep an eye on your account's equity and margin levels and plan your trades accordingly. However, it's worth to mention that the margin call level in Errante is 100% on all accounts, and also the stop out level in Errante is 50% on all accounts. We've already laid the groundwork for understanding margin calls and stop out levels. Now let's bring it all together by mastering the metrics of margin. To fully grasp your trading account's health, you need to be comfortable with a few calculations as you see here. Using our previous example with 200 leverage and a 1.5 lot euro USD trade, let's consider a running profit of $10. Your new equity would be, as you see here, $1,010. And your free margin based on this formula will be $222.5. Also, At this point, your margin level will be approximately 128.2%, indicating a relatively low risk of a margin call. However, caution is still advised. So here you see the interpretation of the free margin. It means $222.50 left to open a new position or sustain potential losses. So this is the money that you have available for trade. And for interpreting the margin level, we can say the 120.2% margin level indicates relatively low risk of the margin call, which is the 100% level. Assume you're trading on a Errante platform. But caution is advised because you may get close to the margin call level, which is 100%, if your open position or your open positions go to more loss. Okay, having a robust understanding of margins and equity is vital, but what about the costs associated with holding positions overnight? That's where swaps come into play. So let's see what are swaps. Swaps are a fascinating and often misunderstood aspect of forex trading. They essentially represent the interest you either earn or pay for holding a position overnight. There are two types, swap long and swap short. Swap long is the interest you either earn or pay for holding a long position overnight. In layman's term, if you're bullish on a currency pair and decide to hold its optimism through the night, you are entering into the realm of swap long. On the other hand, swap short is the interest incurred or earned for holding a short position overnight. This is the flip side of the coin. So to speak, for traders who are bearish on the currency pair now, let's talk about negative swaps. It might be interesting for you to see on some brokers' websites that there is negative swaps, maybe for long swaps or short swaps. These occur when the currency you are borrowing has a higher interest rate than the one you are buying. What does it mean? Let me explain it in this way. Essentially, you're paying a premium to hold your position, and it's a cost that can accumulate if you're not careful. Positive swaps are the more appealing side of the equation. You actually earn interest for holding the position overnight. This often occurs when you're buying a currency with a higher interest rate compared to the one you're selling, and is particularly beneficial for carry trade strategies where you aim to profit from the interest rate differential between two currencies. On the flip side, negative swaps usually happen when buying a currency with a lower interest rate. While it's a cost, it's a known one, and it can erode the profits of long-term trades if not accounted for. In summary, swaps are not just numbers, but the strategic elements that can influence your trading decisions. Understanding them can help you better plan your trades and manage risks, and even discover new trading strategies like carry trades. You just laid the groundwork for understanding what swaps are in forex trading, but now let's look at the math behind it. The formulas for calculating swap charges or gains can guide you in your trading decisions. How? All right. As traders, we can't shy away from numbers, and they are at the heart of what we do. In the realm of swaps, understanding the formula is key to effective risk management and strategic planning. The formula for swap short for one night is size of the trade in terms of lots times the contract size times the point size times the swap short rate that you can find on the website of a broker. Let's consider the real world example. If you hold a 0.5 a lot short position on your USD on a Tuesday night, your one night swap charge would be calculated as follows. In this case, you would actually earn $11.45 for holding this position overnight. As you see, you have a positive swap here for holding this short position on your USD overnight. Similarly, the formula for stop long for one night is just the lots, uh, the size or the amount of your trade in terms of lots times the contract size times the point size times the swap long rate. And for example, if you hold half a lot long position of your USD, your swap cost for one night would be 0.5 times 100,000 times the 1 pip times the swap rate, uh, which is a swap long here. And you see, it's going to be a $45.5. In this case, you would be charged $45.50 for holding the position overnight. So the key takeaways is this: understanding how to calculate swaps allows you to anticipate the cost or gains associated with holding a position overnight. This is essential for long-term strategic planning and effective risk management. Knowing these numbers in advance helps you decide whether to hold a position or close it before the trading day ends. In summary, mastering the art of calculating swaps is crucial, and understanding the concept itself. It's not just a number, it's a tool for making informed trading decisions, guys. Now, what if I told you that sometimes you could end up paying triple the swap rate? Let's explore this intriguing aspects as well. 3x swaps. So let's see what is a 3x swap. 3x swaps are, or 3 times swaps are charged on specific days, usually Wednesdays. And for some instrument, it's the Friday. You have to check the specification section in your MetaTrader when you're right clicking on each instrument. You can find the specification and you can find the exact day of calculating the 3-day swap. By the way, let's say the 3 times swap are charged on specific days, usually Wednesdays, to account for the weekend when the forex market is closed. For example, holding a half a lot long position in Euro USD overnight on Wednesday would result in a swap of $1,036.49, while a short position will result in a positive swap of 34.35. So we have cracked, uh, sorry, yeah. All right, listen up, guys. Let's put this into numbers. As you see here. So if you are planning to hold positions through to Thursday, be prepared for the 3 times swap rate. It can significantly impact your trading costs or gains and should factor into your trading strategy. In summary, the phenomenon of 3 times swaps is a unique but essential aspect of forex trading. A deep understanding of it can save you from unexpected charges and maximize your potential gains. Okay, we have dissected the what, the why, and the how of forex swaps. Now let's elevate our understanding by focusing on why swaps are not just the footnotes, but a key aspect of forex trading. Swaps aren't merely a cost of doing business in the forex market. They're a strategic element in your trading arsenal, and let's explore why that is. First off, interest rate differential. Okay, swaps essentially account for the difference in interest rates between two currencies in your pair. You can either earn or pay based on this differential. Positive swaps mean you're earning interest, usually because you're buying a currency with a higher interest rate than the one you're selling. And negative swaps mean you're paying the piper, typically because you're holding a currency with a lower interest rate. And next one is the risk management reason. Swaps help you manage various types of risks, including interest rates and currency risk. Knowledge of swap rates can guide your decision on whether to hold a position overnight or close it before the trading day ends. So swaps aren't just numbers, they are the risk management tools. Now let's talk about carry trade strategy, which can be very interesting for some of you. Some traders specifically use swaps as part of this strategy. Here, you borrow in a low interest rate currency and invest in a high interest rate one. The goal is to earn the interest rate differential, making swaps a central component of this strategy. And lastly, additional points is that swaps should be factored into your overall risk management for sure. And don't forget, swap rates can change based on market conditions, adding an element of unpredictability to the market. Therefore, staying updated on these rates is crucial. Be in contact with your broker all the time to get the updates on the swaps and also maybe uh, the various 3 times swap calculation days. In summary, swaps are far more than just an afterthought, and they are a multi-faceted tool that can influence your trading strategy, risk management, and even your profits. Ignoring them or treating them as just another number can be a costly mistake, guys. Very good. As we wrap up this comprehensive journey through the world of Forex, I'm sure you have questions. So uh, now is the time to get them answered. Let me just check to see if I can answer some of these questions, how many questions we have. Okay, very good, my friend. Asks, how does the volatility of a currency pair affect the spread? Okay, very good. I would say volatility directly affects the liquidity of the asset, which in turn affects the spread. And higher volatility usually leads to a wider spread, increasing the cost of trading, and traders need to be extra cautious about their entry and exit points during high volatility periods because it's directly linked to liquidity. I hope you got your answer. So the other question is that can you elaborate on the risk of using high leverage in a highly volatile market? That's a very good question. I would say high leverage magnifies both gains and losses. In a volatile market, price swings are more significant, and using high leverage can quickly deplete your margin, leading to a margin call or even a stop out if the market moves against you. So you should be really, really careful about the elaboration of the risk. And this is how it works, guys. So the next question is, how does the interest rate differential between two currencies impact the swap rate? Uh, Let me give you a very, very short answer about this. I think the interest rate differential between two currencies in a pair determines whether you will pay or earn a swap. Okay, this is clear. And if the currency you're buying is a higher interest rate than the one you're selling, it means you will typically earn a positive swap. Conversely, you will pay negative swap if the currency you're buying has a lower interest rate. It means, for example, if you open a buy position, you have a base, you are buying a base currency against a cold currency. So in that case, you might consider the interest rate of the base currency compared to the cold currency. But vice versa, when you open a sell position, or let's say you short some a currency pair, for example, GBP USD, it means you are buying USD as a code currency against the GBP. So in that case, if you want to have, let's say, just the imagination or picture of how this interest rate may work, and the swap may affect you, you can consider the interest rates between the US dollars and code currency and the GBP as a base currency. Okay, let's move on to the next question. This is we have. Yeah, could you explain how geopolitical events can impact forex markets and subsequently my trading strategy? It's a good question. Let me uh, give you my thoughts. Geopolitical events can lead to increased volatility and unpredictability in forex markets, okay? And they can impact currency value, interest rates, and economic stability, all of which will affect your trading strategy and may require adjustments to your risk management tactics. This is the reason that many people usually say that we have to be more cautious when we want to trade during the news announcement. Okay, I hope you got your answer. And so let's move on to the next question, which is, how do I incorporate the concept of free margin into my risk management strategy? As I explained, free margin is the amount available to open new positions, okay? And effective risk management will mean maintaining sufficient free margin to withstand adverse market moves, because we can't predict the market all the time. It might be a bad news coming to the market. It might be a shock. Any adverse market moves can just result in in decrease, in a huge decrease of our, let's say, the free margin. So thereby avoiding margin calls and stop outs. So together, we really need to consider our free margin all the time and make sure that we have the adequate amount of money in our account uh, in the case that something might happen to the market unexpectedly. So how can the concept of correlation between different currency pairs affect my portfolio? I may need more time to answer this question, maybe in greater angle details, but let's say understanding correlation helps in portfolio diversification. As we explained in our previous webinar, and I would suggest you to just maybe review that again if you or watch it if you have not watched it yet. If two currency pairs are highly correlated, they move in sync. Okay, so by trading in correlated pairs, you might be doubling your risk. Uh, uh, this is something that unconsciously, let's say, because to explain it in a greater detail, we say, for example, imagine you're opening a position on Euro USD while you think that the euro will strengthen against the dollar because of some good news. And at the same time you open another buy position on another euro pair. In that case, also you think euro should go high against both currencies, because you are expecting a very, very good news announcement from the, let's say, the European Central Bank or something like that, or a good, the robust, let's say, economy results or something like that. But at the end of the day, it means you are just increasing your risk because you have forgotten about the diversification in your portfolio. It means if you have a one lot on your USD, let's say long position, and also a long position on Euro JPY, it means you are two lots at risk against any adverse market movement against Euro. So it means you have increased your risk, the risk of your portfolio overall. So another question is, uh, can you elaborate, just came in, guys, okay. Can you elaborate on the concept of carry trade and how swaps play a role in it? Very good question. In a carry trade, you borrow in a currency with a low interest rate and invest in a currency with a high interest rate, aiming to profit from the interest rate differential. In other language, you may see some people just look at the swaps, okay, to see if there's any possibility to earn a positive swap on something, maybe long or short, and then look at the news to see if these swaps, the positive swaps, that they have the chance, the potential to earn it, are coming along with the good news for that currency, uh, which they can bet on that and maybe hold that position for a longer term period of time. This is usually, I would say, this is the just let's say the strategy that many carry traders may use. So as I was saying, in a carry trade, you borrow in a currency with a low interest rate and invest in a currency with a high interest rate, aiming to profit from the interest rate differential. So swaps are crucial here because a positive swap can add to the profitability of a carry trade, while a negative swap could negate it. But it's also, it can be a very, very bigger, strategy in terms of the hedge funds, when because they have the other, let's say, instrument to play with, like the options. They have much more than CFDs they can play with. But this is the, let's say, the whole concept of carry trade. Very good, very good. I guess I got to your question, guys. By the way, your question and our discussions enrich this webinar today, really. But all good things must come to an end. So let's conclude. Thank you all for participating in this in-depth look at forex trading essentials. It's been a pleasure sharing these insights with you. For more webinars and resources, stay tuned to Errante's educational offerings. Until next time, trade wisely and prosper.